muted.
Thank you so much. Can you hear me okay?
Yes, I'm able to hear you.
Okay, great. And that was a really nice introduction. Thank you so much.
You're welcome.
This is Mark from Right Line Trading, and thank you so much for giving me your time. And I'm just going to I'm going to start with this mandatory disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures, forex, or stock markets, nor for any profits or losses that may be incurred. Participation trading in the forex, futures, or stock markets does involve substantial risk, and it should be understood that a person can lose a substantial amount of money. Therefore, the participation in these markets is not appropriate for everybody. Carefully consider your financial position before you place a trade. Do your own due diligence. Consult a financial advisor prior to making a trade. Right Line Trading is not a registered financial advisor, and we're not licensed commodity trading advisors. And with that said, a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia. And what you're listening to, that's my software. That's the charts dinging in the background. So hopefully that won't interfere. I've published close to 15 peer-reviewed articles in first-tier journals. You can Google them if you put in Sachs MK into Google. And I've been involved in the financial markets for over 20 years. Now, Right Line Trading software is a product of over a decade of analysis of price action, market structure, and indicator algorithms. And what we use is the mathematical modeling of closed systems. We look at each individual market as a closed system. And what our job to do is to define what forces are present in that closed system and how they affect the price. And by defining what forces come to bear on price, we're able to determine how price is going to move out into the future. None of the software that we look at lags the market. All of them lead price and give us a really good idea of where price is going to move out into the future. And I wasn't going to start with this, but I just wanted to show you this week in our live trading room. Hopefully everybody can see that. Now this is actually the back end of my NinjaTrader. And I'm going to just quickly go from the 15th to the 19th. We made $975. And the trades we took, I'll just show you the summary. We had 14 trades. We took 13 winners and 1 loser. Our winning percentage was 92.86%. All of these trades are called well in advance, and everybody in the room gets the opportunity to get in on these trades. So in 4 trading sessions, we had 14 trades, and we made, again, $975. 14 winners, 14 trades, 13 winners, 1 loser. And one of the biggest problems that day traders have is they overtrade. And I've seen traders who take 14 trades in one day. We had 14 trades in 1 week. Very, very minimal commissions and a win percentage of 92.86%. And these are right off my NinjaTrader back end. I want to move this to currencies and show you that, here's the cumulative profit as the week progressed. I had 1 very big loser. That was it. for the entire week. So what I'm going to show you is a trading system I think that you're going to find to be unique. And it's going to give you precise, exact, software-generated entries that work. And it's used by many funded top-step traders. Now, when you're in a trading room, we have a little bit of a mandate, and that is to call the trade out live, well in advance of the trade, have chart trader up and projected, so that when the trade executes, you can see it execute, you can see the targets, you can see the stops. If the target's hit, you can see it hit. If I move my stop, you can see me move my stop. Everything that's done is done with incredible transparency. And again, you have to be given a significant amount of time to get in the trade. Now, the system works on futures, Forex, and stocks, and all indicators have forward-looking ability. You can't get 13 winners and 1 loser on trades unless you have the ability to determine where price is going to move off the right edge of the chart. You've got to have forward-looking ability. The indicator analysis has to lead price. It cannot lag price. So the software is purposed to predict the future movement of price on any financial instrument. Now, what the software is doing is harnessing 2 key forces that determine how price is going to move out into the future. So that's why it works on any financial instrument and on any time frame, because these forces are universal. They work on futures, they work on Forex, they work on stocks. They work on any financial market. And if you're ever told that a specific indicator analysis or any type of software is only works on the Forex markets, or only works on futures, or only stocks, or only a given market, or only a specific time frame, then you know that something about it is broken. If it doesn't harness a universal force that moves price and is not active across every single financial market at any time frame, then it's really not working the way it should be. And it's not harnessing the kind of force with the predictive ability that's appropriate. Now I'm going to skip over this little bit. And what I'm going to do is I'm going to start to talk about the first one that we use, that we rely on very heavily. And that's a very sophisticated analysis of volume. And what it's called is, and I'm sure many of you may have heard of this before, it's called order flow. Now, order flow is a very, very unique force or a unique metric. But if it's not calculated appropriately, it can really lead you down the wrong path and lead you right into a loser. And I'm going to show you why that's true. Every single candle, in fact, every single tick value has a market delta. Now that delta is the difference between the number of traders on the bid and the number of traders on the ask. It's simply telling you the disparity between market depth on the bid side and market depth on the ask side. It's not talking about executed orders, simply market depth. And you get that on every tick level, and if you sum up all the tick levels or pip levels or cent levels in a candle and take the total bid-ask disparity, you come up with a delta value of the candle. And in this case, it's $29.85, so there's significantly more buyers on the dome than there are sellers. So one would assume that there's buying pressure and that the candle is going to close to the upside. And this candle does close to the upside. Now this slide's a little bit blurry, and I apologize for that, but I think you can see what I'm talking about. Now here's the problem with the absolute value of the delta. Here the delta is a plus number. It's plus 222, but it closes to the downside. Now this happens occasionally, but it happens often enough. So if these kind of values aren't filtered out, they're going to really create havoc when you try to trade. And here's a series of candles with the market delta above each one of them. In the vast majority, a positive delta creates an up candle, and a negative delta creates a down candle. But, like I said, sometimes it doesn't work that way. Now, if it did work that way all the time, we'd all be millionaires. Because once this number went significantly positive, we were almost guaranteed an up close, we would know exactly the direction that the market was going to go, and the market is never that simple. So what most software does is simply plot the absolute value of the market delta, create this curve. But as it rises, it doesn't necessarily mean that the candles are closing to the upside, since a large positive delta can be associated with a down candle. So this does not have any predictive value as to what's going to happen on the right edge of the chart. But we know that market delta is valuable. We know it does have predictive value. We just have to figure out how to configure it to make it work for us. So here's how we do it. What we do is we've determined that one standard deviation's worth of data is correct. The candle will always close in the direction of the delta, one standard deviation's worth of data. The outliers, which are more than one standard deviation out, are what have to be eliminated. So if you have to eliminate the outliers and want to take the core amount of the data, and that core data is going to be accurate, this is how we smooth it and kick those outliers out. What we look at is the delta on the two higher multiple time frames. Now, I trade a Unorenko chart, but it doesn't matter what kind of chart you trade. You can trade a time chart, a tick chart. It doesn't make any difference. It's going to look at the two higher multiple time frame chart. If you trade a 2-minute, it's going to look at a 6-minute and an 18-minute. If you trade a 5-minute, it's going to look at a 15-minute and a 45-minute. If you trade an 8 range, it's going to look at a 13 range and a 21 range, which are the two higher Fibonacci numbers. If you trade a 377 tick, it's going to look at the 610 tick and the next higher Fib number tick. It's not going to accumulate any data from your trading chart, only from the two higher time frames. And what it does is it puts each of those market delta values into a 15-period simple moving average. Now, because you're taking the average of 15 market deltas and smoothing them out with a 15-period SMA, the slope and the fact that we're going 15 periods back very accurately tells you whether, based on market delta analysis, the bulls are in control of the market or the bears are in control of the market. It's extremely accurate. So when both 15-period SMAs, which effectively filter out the outliers and utilize that core standard deviation's worth of data, when they are both sloping up, the bulls are firmly in control of the market, and the market and the order flow line will be green. When both 15-period SMAs are sloping down, the bears are firmly in control, and the order flow line is going to be red. When the two moving averages are moving in different directions, then you're going to get a yellow order flow line. Now, I wanted to. These are some representations. We're gonna look at a lot of live charts on any time frame, and on any instrument that you'd like me to look at. But I wanted you to get an idea of the analysis. Now, if you try to trade against the direction of order flow, you're going to get stopped out, almost always. And order flow is a leading indicator. This order flow line is going to turn green before price starts to rise. So if price is going down, you see the line turn green, that first pivot up is your entry, and up you go. Now we always trend trade, and there's a couple of more rules than this, which I'm gonna show you. So we're never going to take this counter trend. This counter trend trade is doomed because order flow is green. And these traders are trying to go short here, and they're going to wind up getting beaten up. Even this trade, even though order flow is turned briefly, is really also doomed because, as I'm going to show you when we define market structure and price action, you have to trade in the direction of the trend. You're looking to take the trade long again when order flow turns green. Now, if you do really want to counter trend trade, which I don't recommend, you can try, as the traders did here, when order flow changes. But a counter trend trade is very, very treacherous. And I've been day trading for 15 years and have not found a reliable way to consistently make profit off of counter trend trading. And there's a really good reason for that, which I'm going to go into in a minute when we look at the Laguerre or momentum assessment. Here's another example where price falls and then turns when order flow turns. And anybody caught in the counter trend direction are going to get stopped out. One of the problems you have is you're getting winners, but you're also getting stopped out too often. This is likely the reason. Now, these counter trend traders are very advantageous to us, and we look for them because when traders try to trade in the counter trend direction against the direction of order flow, it's great for us to pick up the trade on the next up candle because we get to run these traders over. And as we run them over, they get stopped out. And as they get stopped out, they have to buy their contracts back, and they help propel this market back to the upside. Same thing here. You get two candles down, you get a lot of sellers here. The market is going to move in the direction of order flow, which is still green, and we're going to stop these traders out, and they're going to help push this trade up. That's why we're retracement traders into a defined trend. We want traders to come in, try to push the market in the counter trend direction against order flow, so we're sitting and waiting to run them over. So I don't know why they're counter trend trading. Some of them may be trading oscillator divergence, MACD divergence. I'm going to talk a little bit later about why divergent signals no longer work, why Elliott wave doesn't work anymore, Gann theory doesn't work anymore. I'm going to go into all of that, but you cannot do this. It's going to wind up getting you beaten up. Same thing here again. Order flow gives you an absolute direction. This is not an entry. This is simply a direction. When it's yellow, you don't trade. When it's red, take the down. When it's green, take the first up pivot, first up candle, and ride it up. And it also is really important. You know, when I ask a lot of traders, what is the most important thing? What is your mandate when you day trade? vast majority say to get winners. But I'm telling you that is not correct. The number one goal when you day trade is to avoid taking losers. Now, we only took one loser all week, and on 14 trades, we made almost $1,000. The point is, if you can avoid taking losers, you can make a lot of money on just a few winners. And in a week's worth of trading, we crossed as many contracts as some traders cross in a day. So you don't have to take many trades when you cherry pick your perfect entries, and you must have indicators that allow you to determine and help you determine when there's chop. And when order flow continually changes direction, it helps us define chop. And when order flow turns green and stays green, the market's going to rise. And remember, this assessment is not made based on any data that's taken off your trading chart. This data is taken all off of the two higher time frames. No matter what you're trading, time, tick, range, Unirenko, doesn't matter. Price moves in this direction because the data is coming in from the higher time frames, and the higher time frames lead price on your trading chart. This market delta analysis based on the higher time frames is really going to tell us how price is going to move on our trading chart. Now I'm going to come out of this slide deck, and I'm going to move into a different one, which I have hidden somewhere. It's right here. I got it. I'll put it over here. And now I'm going to talk a little bit about, I can't say, this is centered, whoops, let me rotate that. Now, I want to talk a little bit about oscillators. Now, the oscillator was created by George Lane in 1957. George Lane was a really brilliant mathematician. Now, he created the stochastic oscillator, and he was really, really a brilliant guy. Now, back in 1957, he created the oscillator to make a momentum assessment. And if you go onto YouTube and you Google oscillator, you're going to find there's a very, very little bit of it. There's not much information on how to use it and how to trade it. I mean, standard oscillators are essentially used to look for overbought, oversold situations, and primarily to look for divergent signals. Now, we do not use the oscillator like this at all. And if you do, again, you're going to find that you're going to get really beaten up. Now, just a little bit about what the oscillator does. The oscillator calculates momentum, or the rate of change in speed of price as it moves up or down. So it's a second order derivation. And his conclusion was that momentum, because it's a second order derivation, would leave price. And he was right. And to give you an example of what momentum is, just say that if we look at a car moving around a racetrack and it's moving at 100 miles an hour and its speed is constant, it's not accelerating or decelerating, its momentum is constant. As it begins to pick up in speed from 100 to 200 to 300 to 400, the rate of change of speed starts to increase and its momentum increases. That's what we're looking for in price. We're looking for price to accelerate to the upside, not just move to the upside at a constant speed, but to accelerate in price to the upside so that it gathers momentum as it moves to its high or gathers momentum as it moves to its low. And that changes in momentum will occur before change in price occurs. So he looked at the oscillator purely to foreshadow bullish or bearish divergences. He did not use it as a trend following tool. That's the only way he traded it. Now, back in 1957, when there was very, very rudimentary charting, and I'm willing to bet that he was correct, that this oscillator, in looking for divergent signals, was extremely accurate. But the market has changed dramatically from 1957 from today. Now, this slide simply recaps what I talked about in terms of rate of change. Now, I just wanted to go look quickly at the key formula for the oscillator. Now, this is modified a little bit. Actually, it's modified a lot for relative strength. It's modified somewhat for Williams percent K. All the different stochastic indicators, or all the different oscillators, but have slightly different formulas, but their core formula is the same. Now, C is simply the most recent closing price, and C is compared to a moving average, a 14-period moving average of the lows of the previous 14 candles, or the H14, or the high of the previous 14 candles, the average high. And what we look for is the close on a long move to approach the high, and the close on the short move to approach that 14-period low. And as it gets closer and closer to the low, or closer and closer to the high, with greater and greater speed, momentum increases. And that's the calculation of percent K, the line that we look at, the stochastic line. The percent D is just a slower percent K. It's a 3-period moving average. Now, back in 1957, and these are old charts I pulled off the internet. They're not from 1957, but I suspect that what George Lane saw was completely accurate. And I want to show you what he's looking at, what he's trying to determine, and why he felt that the stochastic oscillator was going to tell us how price was going to move out into the future. Now, you can see that price accelerated with this much momentum up to this high. Then it retraced, and it accelerated up to the same high, but its acceleration up to this high was less. It didn't move up with quite as much speed or rate of change in speed as it did here. So the momentum only got this high. So because you had the same price high on lower momentum or decreased price acceleration to the upside, George Lane felt that that was going to be the harbinger or predictor that into the future price was going to collapse. Now you could see price made a third attempt to get up to that high. It never quite made it, but it did it again on that lower amount of momentum, and then price collapsed. So this decrease in momentum or decreased price acceleration to the upside was the signal that you were going to see a collapse in price. And like I said, in 57 and 60, in the 60s and 70s, I bet this was a very, very accurate signal. And I just created another example where price accelerated up to this high with this much momentum. Then it accelerated up to this high with the same amount of momentum. Now, when price makes a higher high, you want to see it accelerate up to that high faster. And because it accelerated up with only the same amount of momentum or the same amount of speed, it foretold a huge drop in price. So these were both two successful divergence signals. But you and I both know that if you try to trade these in general, they're going to fail very often. And I'm going to talk to you about why. And we can't use a signal where we can't assess when it's going to succeed and when it's going to fail. Sometimes when a signal works sometimes and doesn't work other times, and we can't make an assessment as to when it's going to work and when it's not going to work, it's absolutely not usable. You got to discard it. And divergence is one that you cannot trade. You can't trade oscillator divergence, MACD divergence, any kind of divergence. Now, again, also, if you use the oscillator back then, when you got a drop in price across the 80 line and the price is overbought, you got a sell signal. When it came up above the 20 line from oversold, you got a buy. Another move up across the 20 line, a buy. A move up across the 20 line, you got a beautiful buy. Below the 80 line, not quite so good. But here below the 20 line, drop below the 80 line, a huge move down. And above the 20 line, a huge move up. So these were fairly reliable signals. And if you had a tight stop, you were able to make a lot of money on these signals. And I'm also going to tell you why these don't work anymore either. Now, what's present in the market today is just a completely different paradigm. And if we don't flex to it and understand what's going on, we are not going to be able to trade profitably. You're not going to have a week where you have 15 trades and get 14 winners and 1 loser. And the reason is because institutional money now really dominates most markets. You trade the E-mini, you trade the NASDAQ, you trade crude, you trade gold. 60 to 80% of all volume that crosses in a given day is institutional volume. So the market, and the institutional volume is going to determine the direction of price. So you can be overbought on a day trading basis for 25 or 30 minutes as institutional volume continues to press the market long or press it short. And it doesn't make any difference that the oscillator is overbought or oversold. Institutional money doesn't care, and it's going to push price long or push price short as far as it wants to, irrespective of what your oscillator is telling you. And if you try to trade a divergent signal in the middle of an institutional move, you're just going to get completely run over. That's the problem now with trading a top or a bottom or trying to trade divergent signals. All we can do is trade in the direction of institutional money. Try to get in early and trade with it, and never try to counter trend trade against it. Like, we're not taking divergent signals anymore. And I'm going to show you trades where traders will try multiple times to counter trend trade the market, and all they do is get whacked, beaten up. Eventually, when the institutional traders step aside, the market's going to pull back strong. But you have to wait, and you don't know when the institutional traders are going to step aside. Because I've seen lots of moves where they'll take a deep breath, volume will drop off, price will come back 2 or 3 candles, and then they come back with a vengeance, and they just push the market up another 25 or 30 ticks or pips, or another 50 or 60 cents, depending upon what stock you're trading. You have to wait and only trade in the direction of the trend with institutional money as your tailwind. Now, again, just it's a little bit redundant, but when oscillators developed, there wasn't this institutional volume. Now, here's I think what's a really important principle, and if this is the only thing that you take home from this from the information that I'm giving you, I think this will make hopefully my talk very advantageous. Back when Japanese candlestick formations were created 400 years ago, when the rice traders created them, back when Elliott wave was created and Gann theory and divergence signals were used, the assumption was made that the power of each buyer was approximately equal to the power of each seller. Japanese candlestick patterns, which I happen to love, and I've spent an enormous amount of time memorizing and still look at, were predicated on the fact that the power of each buyer and the power of each seller was essentially equal as you average it over time. But this is not true anymore because institutional volume steps in and just crushes everything. And so all of these methods for day trading or swing trading the market have become appreciably weaker. If you try to get into a trade on the basis of a Japanese candlestick pattern or a divergence signal or using Elliott wave theory, and there's a bunch of others too that I'm not going to mention, you're going to get beaten up because you're not taking into account the direction of institutional volume. And that is the dominant force present in the market today. Now, what does this mean for us? So what I've created here are a few trading rules that you must adhere to, in my opinion, in my humble opinion, or you can't trade profitably. The first is there's no such thing as an overbought or oversold signal. It's now a fallacy because of institutional money. Now, if there's no such thing as an overbought or oversold signal, there is no mathematical way to determine a top or a bottom. Now, you're going to have a lot of people telling you different. A lot of people are going to try to offer you software that are going to call tops and bottoms. But they can't. And the reason they can't is they don't know when institutional money is finished crushing the market to the upside or blowing it to the downside. So there is no mathematical way of determining overbought or oversold. Markets are going to reverse direction solely at the whim of institutional money. And let me tell you, 99% of the time, when institutional money is not involved in the markets, they just chop. When it's just the small commercial traders like you and I trading, there is no defined trend. So the only time you want to trade is when big money is involved. And I'm going to tell you, and I'm going to show you, the way to get into the trade is following right behind them. It's just about stepping on the back of their shoes. So as they pick it up to take the next step, your foot's on it, and they kind of they take the step and they leave their shoe behind. That's how closely you want to follow them. Now, the principle of reversion to the mean still applies as price moves farther and farther off of mean price, and you're going to define mean price. It could be the 50 period simple moving average. It could be the 100 period simple moving average. For our day trading purposes, we use a 50 exponential. A 50 exponential. But it doesn't make any difference. Price is still going to want to pull back to the average price over that period of time that you're looking at. And what's going to happen is the farther off the mean it's pulled, the faster it will snap back to the mean, but it will only snap back when institutional money steps aside, and we can't predict when it's going to step aside. So we can't make these counter trend trades work for us. And let me tell you, it's not because I haven't tried. But I've just come to this conclusion after many years of trading and seeing what's going on. So trading divergence is tantamount to trading against money flow, against institutional money. And we can only trade in that direction. So what we're looking for here is a momentum indicator that is created not to look for potential divergence, but to look for significant buying and selling pressure, the kind of buying and selling pressure that can only be created by institutional money. And with it, it allows you to indirectly follow the footprint of big money. And we can't, there's no indicator that taps into the computers of an institution and tells us when that switch is flipped. We can only see it happen on our charts and get in quick. Now, the Laguerre oscillator is different than every other oscillator. It has multiple inputs. Its default defined gamma is 0.5. And we modify the gamma. And it has multiple filters to calculate in the end what its Laguerre line looks like. I don't even call it a %K line, although you could, because it's assessing momentum just in a very elegant way, and it's not geared to create a divergence signal. It's geared to follow the trend and look at the direction of momentum. Now, here's how we leverage momentum. We don't counter trend trade it, we trade with it. Now, you can see right here, this line crosses above the 20 line. That's the Laguerre line, the cyan line. You're going to get an up arrow intra-candle. And that up arrow tells you that momentum is now moving to the upside. Then when it locks above the 80 line and stays long like that, the only thing that can do this is institutional money. And we're going to take that trade longer, higher, and higher. Now, you can exit on this signal. This is not a great slide, but it demonstrates what I'm trying to say. As the Laguerre line moves up and it locks long, we're going to trade that instrument long. Now, this is a QQQ on a 30-minute. This is a better slide. Here's a 60-minute. I wrote, I like the 60-minute chart the best. And I like trading the 60-minute the best too. Although it doesn't make any difference what time frame you use. But you can see you've got the shift in momentum right here with the arrow, crossing the 80 line to the downside. Then you get this lock to the downside. Now, only institutional money can lock the Laguerre short. The selling pressure here is intense. And the only thing you can do is stay in this trade to the short side. And you're going to get an enormous trade. You're not looking to counter trend trade. You're not looking for divergence. The Laguerre, the way we formatted it, won't give you a divergence signal. It's a trend following tool. Here's another example. This is on a daily of the Qs. And I wanted to vary the time frames to show you that it doesn't matter what instrument you're trading. This is a sort of an index stock. I don't know exactly how you would define it. But it acts and behaves like a stock. There's your hour. It's gonna signal intra-candle. It's gonna flicker. When it prints, you've got your momentum to the upside, and you're simply gonna take the trade long with the Laguerre lock green. And it's gonna give you a nice daily long trade. That's a very, very big move. And here's with futures. There's the cross of the 80 line to the downside. The Laguerre locks short, and you simply ride the move short. Out on the up arrow. Shifted momentum to the downside. Get a lock short. Down you go. Now I want to show you the difference between the Laguerre and stochastic. Since stochastic is formatted to trade divergence, oh, it's 250. I want to move to the charts. On these two up candles, stochastic crosses the 20 line up and knocks you out of the trade. The Laguerre stays locked short throughout the move because it's looking for something different. And it keeps price and momentum stay plastered almost at the 0 line. Only institutional money can do this. We can't do this as commercial traders. And you get this entire move because that Laguerre line never crosses the 20 line to the upside. Stochastic just flies up. So will relative strength, so will Williams percent K. Now, just because of the time, I'm going to leave the slides, and we're going to go to the charts. Now, I want to take the charts that, I'll give you some, there are two types of trades, and I want to show you exactly what you're looking at, because this is what you're getting. You're getting a 50 exponential. This tracks like a 15 exponential, only it's better than a 15 exponential. Now, we never look at one time frame. Order flow is assessed on a multi-time frame basis. And you'll notice this is the order flow line. But what I've done is I've projected the results of order flow onto the candle halo. So when the candle halo is magenta, I know that order flow is moving to the downside. When order flow is blue or green, I halo the candle like this. So what you can do is go to the indicators, go to order flow, like that, and simply make it transparent, put it in the same panel as price, it disappears, it makes the chart simpler to assess, and that all the data that you need is simply reflected, the order flow data is reflected in the candle halo. And now what you're looking at is the multi-time frame assessment of momentum. This upper line is called MTF, that's multi-time frame Laguerre. So we're looking at momentum on the two higher time frames, and here is momentum off the chart. So on this move to the downside on the NASDAQ, which I traded today, I waited for all the lines to turn red, red and red. I waited for a pullback, which was the wick. And this is a number 2 trade. It's a pullback into a defined trend, and I took the trade down. And I got a really big winner, just like that. This was at 956, and I got another winner. Right here. Long. The candle's haloed in blue. We've got green, green. The multi-time frame assessment of momentum is up, and up we go. Now we would have gotten, this is a number 2 trade, a number 1 trade, if order flow, if the halo of this candle was blue, we would have been in on the arrow. But we couldn't take it because order flow was against us. Now here's the NASDAQ, and I wanted to show it to you also on crude. And this is on a 5-minute. And I have order flow showing. I'm going to take order flow, and I'm going to make it invisible. Make it transparent, and put it in the same panel as price. To make the chart easier to read, I just want you to see that it's there because it's there in the candle halo. And when you have dual reds right here, you have your chart and your two higher time frames are demonstrating momentum to the downside. You wait for any pullback to resistance and then short the trade. You're trading in the direction of institutional money or multi-time frame assessment of order flow, candles haloed in magenta. The 50's down, the 15 is down. We only go short below the 50 and long above the 50. We have a few rules that we respect in terms of market structure. And you're going to get trades like this over and over again. Look at this long trade right here. Order flow, candles haloed in blue. The multi-time frame assessment of momentum, green, green. And up you go. Right to here. Now, these are big moves on a 5-minute on crude. I mean, if I scale it for you, you're going to see that you're going to take it at candle close. The maximum excursion on this is 25 ticks. Now, this you can't take because the chart, Laguerre, and your multi-time frame have to be moving in the same direction. And here's your long trade, right here. And up you go. This is going to happen over and over again. Does not matter what you're trading. Doesn't matter what the time frame is. It doesn't matter what the instrument is. Now, I think I can rotate this to the Qs. I'm just scared if I do this, it's going to drop my Ninja Trader. Because sometimes, unless you add a chart, now you can use this on Forex. Let me create a new chart really quickly, because I've seen what happens if you take a chart and you rotate the instrument. Every now and then, it'll just collapse on you. I don't want to lose Ninja Trader. And let me just create a new chart off the Qs. Now here are the Qs, right here. Now if you want to trade options, you take a higher time frame, and you can trade any time frame. Or you saw charts that were an hour. I'm going to put in my template, which is my MTF order flow Laguerre template. There it is. Now here are the Qs. Now here's your number 2 entry, long, right here. No, you don't have a trade here. Now here's your great trade short on this pullback right here. And the whole move down. Red all the way down. Red, red, red. And it really does keep you out of chop. Remember I told you that our goal is to avoid chop? Well, when these lines, when you don't have red, 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 or green, 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 it defines really well that you're not going to get a trade. So if you look right here, where price is moving up and down and up and down, it's sort of like a sine wave pattern. Oh, hold on a second. I was going to squeeze it a little bit. This is where you want to stay out of the market. And you can see that you just will never get a defined entry right here. Right here. Up, down, up, down, up, down, up. And then you finally get the down in the entry. But throughout this entire period of time here, look down here. You have no red, 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 no green, 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 no entry. It allows you to stay and stand aside. Now, there are little nuances to the program, and I'm gonna answer questions really quickly. I think I'll run over maybe 1 or 2 minutes, and I hope that I don't get into trouble for that. And if you come aboard, what I'm going to do is I'm going to put you all in a webinar, and we're going to have an open chat, and we're going to talk back and forth about the best places to take a trade. If you trade with triple reds or triple greens, the probability of getting a winner is greater than 80%. And if you can day trade or swing trade with an 80% positive predictive value, you're going to become a profitable day trader. How much money you make is only going to depend upon how many contracts or shares of stock or lots you trade. Now let me quickly just go to the offer. Now here's the offer. It's $699. It's normally $2,000. Now you get free upgrades for life. And we're always making the system better. You get them for nothing. You have 1 month in the live trading room with me. This month we made $1,000. I mean, today, in the last 4 sessions we made $1,000. If you took the trades I called in the live trading room, which we trade live on the right edge of the chart, you would have paid for this and then some. You're going to get a 10-module educational training session. You're going to get the video tutorial library, and you get our pivots indicator, the first 10. I didn't have time to show you how our pivot indicator is different than almost every other, but it is incredibly powerful. We never trade into an unbroken pivot because our pivot indicator does not work like most others. Most are very lazy. Ours work the way they should. They have tremendous predictive value in telling you where price is going to stop, and we don't trade into them. But we trade a break of the pivot, which I'm going to show you in the webinar. There's certain ways to leverage the system, but you got to have a multi-time frame assessment of momentum and a multi-time frame assessment of order flow in your direction. Then I'm just going to show you the best ways to leverage that by getting you some really terrific entries. Now let me quickly look at questions. I've got just a minute or two to answer them. Let me just go to the top. I'm going to try to get through these really quickly. Now some of these are for that were before me. Okay. Brad, we trade with tremendous specificity. Specificity is our desire to avoid taking a loser. Sensitivity is our desire to get a winner. If we want to trade with a positive predictive value of 80%, that's sensitivity over specificity times prevalence. So I can't give you an exact figure for our specificity. All I can tell you is the ultimate outcome of sensitivity over specificity times prevalence is about 80% if you adhere to the rules of trading all greens, trading all reds, and getting in at a really good time, which I'm going to show you if you come aboard. Stephen, right now it can't be automated. Are going to have an automated version of it out very shortly. Maybe in about a week to a week and a half. If you're on this system, you'll get a reduced price for the automated system. No, that's NTN. That's not my doorbell. That's the indicators signaling in the background. I know that's the indicators. I can't help it. I mean, I wanted to show you the charts, and so I wanted to leave the program open. If you want, you can turn off those signals. And you can see right now they're quiet. Yes, it can be turned off. Sure, I'll show it to you, but I got to go really quick, Brian. Here are the trades, right here. Right here. On 415, the entry, this is the entry on 3 contracts. 415, 1002. 415, I mean, these are the actual trades. The trade time, the entry price, the exit time, and this is the profit garnered on each trade. right here. And this is the week from 4:15 to 4:18. This is real. This is not, I mean, you can't make this up. And you can see at the bottom, I'm connected to CQG and Kinetic. This is my real data feed. And these are my real entries. And if you go to summary right here, you can see that it's 14 trades total, 13 winners and 1 loser. And that's, that's not fabricated. That's real. You ask anybody in our trading room, we have 150 traders in our trading room. And that's exactly what we did this week. Okay, Stephanie, you totally get it about institutional order flow to the idea. How about trading around one large options order? Stephanie, I don't really believe you need to look at level 3 activity. I think as long as you're trading in the direction of institutional money, you're all right. And if you're trading in the multi-time frame direction of a momentum assessment like the Laguerre and order flow taken off of a level 2, I think it's enough. And listen, that's in my humble opinion. Some traders like to look at level 3 activity. I just don't do it. I'm profitable with what I do now. And I showed the ETF. It absolutely works on the E-mini S&P. Now, I'm already 6 minutes over, Liddy, but trust me, it's a great tool for the E-mini. I chose to show the NASDAQ because it's more volatile and tougher. You get great E-mini trades. When we have E-mini traders that made $4 or $5 grand this week, I am not kidding you. I have with one guy, Roger, who averages about a grand a day. Now, he trades 6 contracts with each trade, and I only trade 2. And I keep the number of contracts I trade low because I want everybody in the room to be able to follow me. And a lot of traders can't trade 6. But he takes his trade 6 on the E-mini, and he averaged about a grand a day. It's open from about 9:30 a.m. Eastern until we hit our profit target, Jim, or we roll over and die. Normally we hit our profit target. It's open from about 9:30 a.m. Eastern until about 11:30 a.m. Eastern, about 2 hours. Usually we get our profit target earlier. We're looking for $300 to $400 per session. We're looking for a minimum of $1,000 per week after commissions. Now, we didn't hit it this week because we had about 130 in commission, but we're missing a day of trading. So we're very happy. Our trade efficiency, we made over $50 per contract traded, which is incredibly good. The webinar, Brian, are only for traders who come aboard because it's really you need the software to see the best entries, Brian. Yes, it does work on NT8, Gopal, at 7 or 8. It has to run on Ninja. Yeah, I gotta go. I'm getting in my headset. I'm getting warned. Stephanie, it works on everything. Options, E-mini. You can give me a call, but if I don't go, I'm going to get into a lot of trouble here. 7 or 8 are equal. I'm sorry, guys. I gotta go. This week, 1 winner, 1 loser, 13 winners. Okay? NDT will be out next week. I just talked to Sergio. It'll be out on Monday or Tuesday. All right, guys. Listen, I'm gonna run. I've overstepped my time. I'm getting yelled at. This is the offer. If you'd like to come aboard, you can also call us at 786-713-5276 if you have any questions. I'll be here, be happy to answer any of your questions. Take care, everyone. Have a wonderful afternoon. And I so apologize to the webinar organizers. And I'm gonna step off. Thanks, everyone in the room, for giving me your time. Bye-bye, all.
Thank you, Mark, for the great presentation and for joining us on Traders Corner. Our next presenter has been involved in trading and brokering commodities and financial markets for over 30 years. He enjoyed a